Uneducated Economist here, doing the video from the S10 today. A lot of you don't know, or a lot of you remember the S10. I haven't driven it for quite some time. It's been sitting in the barn, just waiting for its day when it gets to be used again. And a buddy of mine whose vehicle had broken down needed some wheels to get to work, and I was able to offer him up the S10 so that he could get himself back and forth to work without too many worries. Other than the look of the car, it's actually a fairly decent running vehicle, and so he was able to get back and forth to work until he was able to get another set of wheels of his own, and I was actually pretty thankful that I could offer it up to him. So that's why I'm in the S10 today. For those of you who are questioning, no, I didn't lose the Explorer. It's not broken down. Nothing's wrong with it. It's fine. It's at home. I just happen to be in the pickup today. All right, so let's talk about whether or not the Federal Reserve could actually fix the economy if there was troubling signs. And this is something that I find quite amusing, and I believe this was a statement coming from Goolsbee, Fed official. Now, when you think about like the Federal Reserve fixing the economy, if the problem of fixing the economy wasn't higher inflation, like the Fed was fixing the problem of bringing inflation down, why would they need to lower interest rates to fix the problem? Because that would be solving the problem, right? You guys, you see what I'm saying? It was just like, okay, so if you were to ask the question even just a few months ago, like say 6, 7, 8 months ago, a year ago, what's the Federal Reserve's problem? Everybody would have said, hey, it's high inflation, right? That's the Fed's problem. They need to fix high inflation. And now if you go and look at the statement coming from Goolsbee, he is saying that the trouble with the economy would be something that's not inflation. Right? Like if the economy goes into trouble, the Federal Reserve can fix it. What trouble are you talking about, Goolsbee? Because I thought we were in trouble with the higher inflation. But this would, like, the inflation coming down and the recessionary pressures and all the stuff that now is bringing us back to normal times. I mean, I'm not saying they're good times. I'm just saying somewhat normal. That's a problem, and they would need to fix that. You guys see where I'm kind of coming from on this? It was just like, I thought the problem that they needed to fix was the higher inflation that we were facing, which is now coming down, which is solving the problem, but that's apparently causing a problem. And the Federal Reserve needs to fix that problem. You see the contradiction that's happening? This is why I find this so amusing when I think about what it is that's being stated out there in the mainstream media and the narrative that is being taken. The Federal Reserve somehow is out of control, doesn't know what they're doing, completely screwed it all up. It's obvious when you see the markets crashing. This is, to me, like, I look back and I'm like, is everybody losing their mind? Is that what's happened? I mean, I'm pretty sure that they just don't know, and they have completely lost their mind, and that they are just stuck at the whims of whatever it is that's being blasted out there, as far as the mainstream media and a lot of the talking heads that's portraying this information. I mean, I'm just like completely, like, I don't know, like, I don't even, like, I have a hard time even fathoming that this is actually happening out there. I mean, how many times did I say it on my channel? Right? The Federal Reserve was going to keep interest rates extra low, extra long for an extended period of time. And then when they go to fight the inflation, that is the problem, the scary thing, even though we know from this channel and the things that we have read that the problem they needed to solve was that an inflation expectation that was persistently too low rather than too high. Well, now they got inflation too high. That was fixing the problem. See, now they got a problem. They even said it, like, as this inflation is coming down and the recessionary pressures are starting to build, they have a problem that's starting to be created, right? See, the Federal Reserve is far more in fear of deflation than they are inflation. Inflation, not a problem. They were going to say, hey, it's quite painful, but, we're sure that we can get the job done, and we're going to stick to it till we get the job done. See, they weren't scared about inflation. Inflation, they were cool with. They liked inflation. Everybody else hates it, right? But the Federal Reserve, they like inflation. They wanted it. They needed it. They got their ammunition back when the inflation expectation was elevated and the actual price inflation started to increase. They were able to get their ammunition back. They were like, oh, man, whew, that was a close one. We almost lost it there, didn't we, guys? See, this is, in a lot of people won't see it this way, but this is the truth of the matter. See, I'm going to try and break it down again on what really is happening here. See, think about it. The idea of the Federal Reserve lowering interest rates going into the future is now pushing the mortgage market down, the mortgage rates down. Okay? Regardless of what anybody else says, just take a look back, right? Don't think about the cause and effects or anything like all that stuff, all the fear, right? And just look at it. What happens when mortgage rates come down? More buyers come to the table, right? Supply-demand issues. Are they increasing the amount of homes that are available? No. They are increasing them, but are they increasing them at a significant pace? No, right? Inventory is still incredibly low. And the idea of lowering interest rates going into the future, which is taking place, even though the Federal Reserve hasn't moved anything yet, just the perception of what's happening here is beginning to lower mortgage rates. If this begins to take place, more buyers can come to the table. Now, is it so significant that all this opportunity for all these people to go out there and buy all these different houses? No, right? But that's the market condition, is that when interest rates come down, unless the house prices go incredibly high, right? The house prices stay the same, the interest rates come down, that brings more buyers to the table. Now, granted, yes, if they cannot afford it, if there's no jobs out there, if there's massive layoffs, if all of a sudden the jobs market turns in a negative way, yeah, all bets be off. There's going to be a significant change to the economy and the way that it's conducted, especially when it comes to home sales. If you don't have a job, you can't make your payment regardless of how low the interest rates are. That makes sense. But the unemployment is still pretty low. Yeah, it's not as good. And all the narrative mainstream media blasting out there for everybody to see about how weak of a jobs market it is. Weak jobs market, weak jobs market. You can hear it constantly out there. Okay? But it's still, on a historical basis, a fairly decent jobs market. Right? I mean, what's the dual mandate? Low inflation with stable prices. Make sure I say that right. And full employment. Well, yeah, the Federal Reserve is achieving that goal. Like, that's their mandate. That's their goal. The 2% target, that's completely, that is like a complete delusional concept. That doesn't exist. It's a 2% over time. But the dual mandate of low inflation and stable prices and full employment, are they not achieving that? I mean, it's like, is it great? No. But is it getting in the direction of achieving that dual mandate? Absolutely. Absolutely it is. And so the belief that the Federal Reserve has no other choice but to lower interest rates going into the future, that exact belief is driving the yields down. It's driving the mortgages down. It's driving the 10-year Treasury down. That's going to then move into the rest of the economy. You're going to find interest rates coming down. The exact belief of it is creating the scenario within the economy. The Fed doesn't have to do anything. In fact, they don't, right? Think about it. Nothing changed and the whole market flipped out and sold off, right? Now, granted, a lot of people might blame that on the carry trade coming from the Japanese yen, but ultimately nothing changed over the last week, except people's perception of what it is that's going to be coming in September with the rate cuts. And because they believe those rate cuts are coming, they believe that's going to be inflation or recessionary pressures that are coming, then they start acting accordingly. Oh, God, there's a recession. What do we do? Get out of your risk assets, all the stocks, the gold, all the cryptos, all that other stuff, and you get into bonds. That's a very typical thing that happens when you have fear and uncertainty that runs through the economy. But is that the reality of the situation? Well, maybe for the Japanese yen part of it, but the rest of it, the interest rate adjustments and the Fed's promising of a September cut, or there's almost a guarantee of one, none of that stuff exists. That is completely imaginary at this point. Okay? So let's think about it. Like, what is it that the Federal Reserve is truly trying to do with their interest rates? To understand what their major problem that they were facing is that they had hit the lower bound of zero. with the Fed funds rate. And this is very important to understand, right? A lot of people say, yeah, okay, so what? They were at zero, that's a ways ago, and now we're at 5.5%. So what? They're they're not even close to the lower bound of zero anymore. Completely moved off of that. It's irrelevant anymore. No, that's not true. It's incredibly relevant. And the reason why it's relevant is because once they hit the lower bound of zero, they realize they cannot create an inflationary scenario. That's very troublesome for the Federal Reserve's monetary policy. Not being able to find inflation. See, everybody else in the world is concerned about inflation because it literally eats away at our efforts. Our time, our savings, all the things that we are doing gets eaten away by inflationary pressures that come to the economy. However, the Federal Reserve is in far more fear of deflation than they are of inflation. And if you don't believe me, just go and check out Ben Bernanke's speech dating all the way back to 2002, talking about how to prevent deflation from ever occurring here in the United States, and how it is that they could create inflationary scenarios even if they hit the lower bound of zero. This is something that they were conceptualizing 20 plus years ago. They knew that this was coming. Right? So to think that it isn't a 20-year-long plan that's going on right now is incorrect. It is definitely a well-orchestrated, well-thought-out, very well-played game that they are executing right now. All right. And now understand that once they hit the lower bound of zero with the Fed funds rate, like they did during the great financial crisis, they failed to produce the inflation. Like typically you would lower rates. What that would do is spawn and spark and spur and drive people into then taking out loans to either buy houses and cars and going on vacation, but more importantly, businesses would begin to invest. They would take that cheap money, invest it into equipment, buildings, hiring people, right? And this is where employment would start to rise. So what the Federal Reserve was trying to deal with their dual mandate of low inflation and stable prices and full employment, and they had unemployment rising, they would try to spark the investment within the business, right? Now, a lot of people just look at it as the consumer part of it. Like, hey, we're trying to drive the consumer. Hey, that's what they're doing. It's doing it, right? Definitely you can say that that's what's happening. As they lower interest rates, people go out there, buy houses, cars, go on vacation. But more importantly, companies are hiring people when they lower the interest rates. And that is what starts creating the inflation, because now you have more consumers starts driving the imbalances of supply, and then you have price increases that are taking place from that. So very important to understand that when the Federal Reserve lowers interest rates to zero, the idea is to spark employment, lower the unemployment, get people working, spending money then has the inflationary pressures that starts to create the growth, right, or whatever. However, when they hit the lower bound of zero after the great financial crisis, there was plenty, during the recession it was a big deal, but after that, they had some of the best jobs numbers in history. We heard about it, like every president, Obama wanted to brag about it, Trump bragged about it, they loved it. They loved the fact that they had the best jobs market in history. But guess what? There was no inflation. The Fed should have been printing money like old Trump was saying, right? What was the problem? Well, the problem was that the interest rate adjustments hitting the lower bound of zero wasn't sparking the inflationary pressures in the economy like the Federal Reserve would typically had seen when the unemployment fell and the massive, beautiful jobs market was created. That should have been an inflationary pressure. It didn't work. It wasn't working for them anymore. And the main reason it doesn't work anymore is because there's something called the neutral interest rate. And this is probably one of the biggest, misunderstood or just even misinformed of, or they didn't even get it. They don't even know it exists. It wasn't even they were misinformed about it. They just even missed it altogether. They have no clue. I say neutral interest rate and they're like, what the hell is a neutral interest rate? If you don't know what a neutral interest rate, then you're failing to understand the Fed's monetary policy. All right? And I'm not trying to be arrogant or ignorant or trying to say you're ignorant or something like that. I'm not trying to be like that. Right? What I'm trying to say is that the neutral interest rate was incredibly important to their monetary policy And as far as them conducting themselves, it essentially had come to an end when that neutral interest rate, which is the rate that is neither accommodating nor restricting the economy, had hit zero. It had come very close to zero. So now stimulating the economy with the lowering of interest rates doesn't work because you hit the lower bound. And now dropping interest rates far enough below neutral doesn't do it. But it fails. It fails to produce the inflationary scenario. And this is very important to understand. Like, understanding that if you have a low neutral interest rate, the return on capital investment becomes negative. Meaning that if you go and loan money, right, when you have a low interest rate and a very low neutral interest rate, and you have returns on capital investment that fail to beat the inflationary scenario, then what you have is a return on capital investment that has a deflationary aspect to it. And this happens at the lower bound of zero. It's something that we were facing. No matter how much money you print, it doesn't create the inflation. Not when you're at the lower bound of zero trying to stimulate the economy and you can't drop interest rates far enough below the neutral interest rate. See, they had predictions back during the great financial crisis that in order to do an interest rate adjustment that would stimulate the economy in the traditional fashion, they would have had to take negative interest rates to 6.5% in order to stimulate the economy. It wasn't going to work. They couldn't do it. Like, how do you take interest rates, the Fed funds rate, 6.5% negative? It would have flipped the markets out and nobody would have, it would have seized up, right? Nobody would have been loaning money out at a negative interest rate of 6.5%. But that's what their projections were, is like, that's what it's going to need in order to save this economy. Knowing that they couldn't drop interest rates into 6.5% negative territory, they came up with the quantitative easing, right? Where they would go into that massive asset purchases, buying up all those treasury bonds, buying up the mortgage-backed securities, putting out the narrative, right? I mean, I know I was one of them during the great financial crisis who was screaming hyperinflation, right? Better get into silver, better get into gold, get out of the dollar, hyperinflation coming, guaranteed. Balance sheet expansion from $8.5 billion to over $4.5 trillion, hyperinflation on its way. Everybody knew it, right? Well, inflation expectations is what creates an inflationary scenario. They were able to get some out of it, but it wasn't enough. The Federal Reserve failed to achieve the 2% target that they were looking for after the great financial crisis, after the expansion of the balance sheet, after all the money printing. Still failed to produce the inflationary scenario that they so desperately needed. And so when it came to the pandemic, and they were running out of monetary policy in order to stimulate the economy, they had moved interest rates up to 2.5%, only to find themselves almost immediately having to reverse course because of the dramatic slowdown that was hitting the economy. They start to lower interest rates, and lo and behold, pandemic kicks in. Wow. Man, wasn't that convenient? I mean, we were heading into a recession, but now we got a pandemic-induced recession that created it. Not the slowdown in global economics that was creating a recessionary outcome that had no real reason for the Federal Reserve to step up with their unusual and exigent circumstance powers, mainly Fed 13.3, which gave them the ability to set up special purpose vehicles and start backstopping every corner of the financial market during the pandemic. If they didn't have that, they would have had no way of having any real excuse for creating all the stimulus and bailouts. They would have had to let the system collapse because they don't have any legal authority to do what they did unless they have the unusual and exigent circumstance, which totally saved them. So now they have stimulus packages that are being pushed out there. They have a severing of the supply chain from telling everybody to go home and not go to work. They got the inflationary pressures to start building up in the economy. And next thing you know, they're fighting off the inflation. Oh, bad inflation. Got to get those Fed funds rates up. Hey, boys, guess what? We're getting our ammo back. That's what they were telling themselves. So the inflationary pressure starts to push into the economy. The Federal Reserve is, hey, we kept interest rates too low for too long. Yeah, got the inflation up there, got the elevated inflation expectation, right? Got to fight the off of the inflation. So we're going to raise the Fed funds rate up to 5.5%. Well, now the neutral interest rate begins to rise. See, the inflation expectation in the elevated inflation scenario and the elevated interest rates begins to raise the neutral interest rate. Well, if this scenario goes on for some time and the neutral interest rate continues to rise, well, then it gets ever closer to the Fed funds rate, which makes it less restrictive. People wonder why it is that we have just such a resilient economy for all this time. How is it that we don't have a housing market that just crashes because of price, right? We have a less restrictive economy as the neutral interest rate continues to rise. Very important to understand this stuff, right? Because nobody else is going to tell you about that neutral interest rate. They're certainly not going to incorporate it into the strategy. And they're certainly not going to believe or understand how it is that the Federal Reserve needed an elevated inflation expectation to raise that neutral interest rate. So now that we got the neutral interest rate beginning to rise, well, if we have a situation in which that people believe that there is going to be lower interest rates coming into the future, well, they'll start acting accordingly. Okay? And what do you start to see? Mortgage rates come down. You start to see the 10-year Treasury come down. Give it time, and this will start moving into the economy. And will start to have real effects on the economy with lower interest rates before the Federal Reserve does anything. See, a lot of people are going to say, no, the markets are pushing the Fed into this direction. Look, they're already acting in accordance to what they want the Federal Reserve to do. No, right? That's not what's happening. That's not what's happening at all. Right? These people are in belief that there is going to be rate cuts coming into the future. They believe that if the Federal Reserve was to lower rates, that they are trying to fight off of recessionary pressures. With that belief, they start creating a stimulating effect within the economy itself. Okay. And again, it's important to understand how this has taken place and why it takes place. See, if the Federal Reserve was to lower rates right now, they're giving up their ammo. They're giving it up. They're just basically just saying, well, we don't want this anymore. We don't want to use interest rate adjustments to try and stimulate the economy. We obviously just like, this is worthless to us. And they'll just give it away. That is not what the Federal Reserve is up to. The Federal Reserve needs to have control of the narrative, the belief of what those rates will do. That is the most important part. Right? And if they have an open-ended discussion about it, the open-ended signaling, we don't know, wait and see, data dependent, have to get there to find out what's happening, and then push out there all this idea, rate cuts. If things are like this, rate cuts, weak job market, gonna force rate cuts. You put this out there and you're gonna have an economy that is operating as if the rate cuts had already taken place. Then you get there and they're like, well, according to the data, looks like things didn't really come down in the fashion that we were thinking. I wonder why. Okay. So we may have to wait and see just a little bit longer. The moment they commit, that's it. They're on that direction. They cannot reverse course. At least right now, they can use the idea of, hey, we may need to wait and see to have a restrictive policy within their midst, right? But the moment they give that up, they don't have the ability to have a restrictive economy, because the moment that they say, hey, we're going to have to reverse course on our cuts and actually increase, it will lose the credibility. They will no longer have the credible threat. That is the last thing that they want to lose. So they know that they can put pain on the economy and it won't be a grave mistake. Cutting rates too early would be a grave mistake. Cutting them too late, painful. Well, they already promised us pain. They said that households and businesses would be experiencing pain. Right? And so when you think about interest rates coming down, you think about prices coming down, and all of a sudden the Federal Reserve saying, hey, we could fix that. Yeah, you want a job, right? I mean, you want to work. Okay, so we can fix that other problem there we have with inflation coming down and the recessionary pressures and interest rates coming down. We can fix that problem, right? Like, to me, that is like it's such a backwards way of understanding how it is that they are trying to conduct themselves, right? And it's understandable to the traditional classical way of understanding the Fed. Like, that part I totally get. Like, if you don't understand the average inflation rate over time, if you don't understand credible threat theory, if you don't understand any of that stuff or never heard of it, and you're looking at the Fed in the classical form, then it totally makes sense when they use these communications out there, because that's how they do it, right? They have control over that narrative from the typical understanding of how the Fed operated. Mainly it's that 2% target, right? They got it, man. 99% of the people out there are anticipating a 2% target for the Federal Reserve's monetary policy, 2% target on the inflation rate. Doesn't exist. Simply does not exist. There is no 2% target that the Federal Reserve is going for. It's a 2% average inflation rate over time with no mathematical formula for figuring it out. We already know this from the Federal Reserve's own statements. Jerome Powell said that in a speech August 20th of 2020. Right? You can go look at it yourself. Just type in Jerome's speech August 20th, 2020. Right? And you will find it in there itself. I don't have my computer, so I can't read it to you, but believe me, it's there. And this is the exact same message that was reiterated at the congressional hearing, and Michelle Bowman, who is a voting member of the FOMC, reiterated that exact same statement in a speech given just 2 months ago. There is no 2% target, period, doesn't exist. All right. But yet 99% of the hedge funds managers, the economists out there, the financial advisors, most of the people that you listen to talking about it, they all talk about a 2% target and what the Federal Reserve is doing with their strategy. Wrong. So wrong, right? And I don't know why it is that I'm the only one who is just so adamant about pushing this out there to try and make sure that everybody is well aware of the average inflation rate over time as opposed to the 2% target. But I feel that if that was the one key piece of information that everybody had, the Federal Reserve would fail at their operations. They wouldn't be able to do this anymore. So people say, hey, man, we need to end the Fed, fight the Fed, figure out how it is that we can disband the Fed or get it out of our lives. It's this. This is what I am doing right now and trying to explain it out there to the people. If they were to internalize it the way that we have on this channel, it wouldn't work. Their system would not work anymore. All right. Man, I really went off for 27 minutes here. We got maybe about 5 more minutes left. What do we got here? The thing that I wonder about is if the Fed has no real formula for inflation, do they really know what they are doing? Yes, they do. Stay curious, because it's not an inflationary formula that says, hey, we got this mathematical formula for figuring out over a certain amount of time. That's not the way they do inflation. Now, let me see if I can kind of explain this really quickly, because I don't have a whole lot of time left. The way that the Federal Reserve is looking at inflation is they look backward inflation, backward average inflation. Okay. And now, if you can just take into your imagination right now, just take into a thought that if you were to figure out the average inflation for the last, say, 6 months, you wouldn't find a spot in there that had a 2% average, right? If you took it back a year, you wouldn't find a spot that had a 2% average. You take it back 4 years, you may not find a spot that has a 2% average. You take it back 10 years, and you may start to find where the average inflation rate is down because of all the elevated inflation that we have experienced here and the lack of the 2% target inflation that we had experienced prior to the pandemic. So you start incorporating some of that failure to achieve the 2% target into the elevated inflation that we have, and you go back far enough, which I think you have to go back to somewhere around 2008, 2009, you will find that there is a moment back there somewhere in time incorporating all the elevated inflation we've had and all the deviations below the 2% target. You take it back far enough and you will find there is a moment in time that hits the 2% target, that hits that 2% average. Now, again, it's not necessarily a target, it's just a view back there in time. Like, how far back do we have to look to find where, all the current inflation we've experienced plus all the deviations from it averages 2%. And that's how they see it. They look back and say, how far back is the 2% average inflation? Okay? So there is a formula for figuring it out 2%, but it's not a set timeline. It's a view going backwards, looking to see how far back 2% average inflation really is. See, once they have achieved it, if they have current inflation at 2% and they have this backward inflation where it cannot meet any closer to this current timeline at 2%, they could then shift, right? Because they would be like the 2% average over time is 2%. The forward looking would be 2% average. The current is 2%, right? Well, at that point, they could be in a forward looking average inflation, meaning that they deviate below 2%, they make it up with an elevated inflation, right? And so from that point on, they can either be at 3 or 1% forever, achieving the 2% average inflation rate of 2% over time. Right? It's important to understand because they don't use a mathematical formula, because there is no mathematical formula, because you have to go and adjust the timeline to figure out how far back you have to look in order to find the 2%. And that's going to change as current inflation continues to move on and change itself, right? The average over time looking backwards will then find its different timeline, you know? Very important. Like I've broken all this stuff down in my member only videos, guys. Like my member only videos share all this information. You want to break it down, you want to internalize it, you have to go through the work just like we did. And I've done the majority of the work for you by literally breaking down those speeches in a video for you to listen to, be involved with, join in on the discussion of it. And it's $1 a month. Like it literally is $1 a month, $12 a year, $120 a decade for the hardcore research information, bringing that to you in a way that you can break down and internalize as a normal everyday guy, right? Like we're not people, like I didn't go to school. I don't have college degrees. I didn't work in finance. I don't do banking. I'm not an investor, none of that stuff. I'm just a guy with access to the internet just like everybody else, but I've poured through hundreds of speeches in order to internalize this information and be able to share it with you. And now, again, for $1 a month, you can go join the channel, go look at all those member-only videos, watch them, go through them, join in on some of the discussion, ask questions, right? And you will have the same information that I have. Like, I didn't make this stuff up, guys. Like, I'm not theorizing on this like, hey, man, I believe by, in my heart of hearts, this is the way that no, man, like I've gone through and found this being stated from the Federal Reserve itself. And then realizing that the communication style within itself is also part of the strategy and their tools. Like there was a time when the Fed never communicated to you. They didn't say anything. Like one day you just wake up and interest rates had moved and nobody even knew why. They thought it was important to shock the markets with it. Greenspan would be very, very difficult to understand. In fact, he even had a famous quote that said something, if I made myself clear, you probably misunderstood me, right? Like this is how Greenspan operated. And they did that because they wanted to keep the markets very confused, and then they shock them with these interest rate adjustments, where they realized that the more that they communicated about the rate adjustments, that they could get more power out of it. And the more they communicated, the more power they got. And the more they communicated, they realized, hell, it's more about the communication of the rate cuts or rate adjustments than about the rate adjustments themselves. And so they set up all these different kind of communication styles in order to communicate and control the narrative so that they would have operations existing exactly like we were experiencing today, where you see all this impact to things like the mortgage markets, yields on 10-year treasuries, all this stuff, and yet the Federal Reserve hasn't changed anything about what they're doing. They're literally sitting on their hands and using their words to guide the markets, and it's totally working. And this is something that they have explained within their own statements and speeches that we have covered on the members only live stream. If you want that same information, $1 a month, go check it out. There's links down in the description for you. There's hours and hours of information to pour over and internalize, and once you got it, you see it plain as day. Alrighty guys, I'm sorry I just whoops. just kind of took over the stream here and didn't really read through many comments. I hope you guys had a good conversation here. This is nothing more than the results of kicking the can down the curb. All right. Thanks, everyone. Thanks for staying mature and allowing my son and I to get this demo done. Such a great chat here. Well, thank you, All Nighter, for being here, man. Thank you for all you do. All right. Fed only, I'm going to read a couple more comments here and then I got to go. Fed only controls short-term Fed funds rate, reserve requirements, ratios directly. Job owning only goes so far, and they have exponentially increased moral hazard with their interventions in 2008 and 2020. Yeah, and I don't disagree with that. Another perspective, I don't. Like, I agree with a lot of that stuff, but I also feel like they don't really have any other choice if they want to stay in existence. Now, again, like, I'm not trying to say that's a good or bad thing. I'm just saying that's what they are doing in order to try and continue on with a financial system of their creations like they have done, which has now impacted every single person's lives. I mean, I can't believe, it just blows me away that the FOMC, literally 12 votes, has so much impact on the lives of every single person on this planet. All right? It's scary to think about, but that's literally the case. All righty. Do they precisely define inflation, or is it up to interpretation? Because when we hit 9% inflation on the CPI, they removed used car sales from the metric in April of 2022. No, like, you can't, like, inflation is dumb. It's the dumbest reading in the entire world, right? And so it doesn't matter to me, like, what it is that they are reading inflation from, because the way that they should read inflation, in my opinion, isn't even remotely close to what they're doing. But then again, I'm not in charge of monetary policy, and so therefore it's not up to me to decide whether or not they should look at this or that or the other thing. I have to look at what it is that they are looking at. And if they decide to conveniently remove something from the CPI so that it jives more with their numbers, I have to accept that, because, again, I'm not in charge of monetary policy. They are. So if they want to do that, then that's the case, and then we have to follow it after that without that particular, item to then adjust the inflationary scenarios that we would typically anticipate, right? So much like they don't judge inflation like they did back in the early 80s to the way they do it now. So to say inflation back then was this and it is this today, that doesn't make any sense, right? It's not even comparing apples to apples or apples to oranges. Like, what do they say? It's like comparing, hamburger to steak or something, like, to a ribeye or something. It's like not even barely the same thing. All right. Thank you so much, Brandon. Fortified General Contractors for the $1.99 says weekly donation, man. Thank you so much. I really appreciate the support, man. You're very cool. All righty, guys. I got to call it quits at that. I hope you enjoyed the live stream. I hope you enjoy the credible threat theory. Like, this is one that is now playing out. It's kind of interesting. I now have in noticing that a lot of people are going back about a year onto my channel and watching some of the videos that I had put out a year ago, and they are saying on there, man, nice call. You called this or whatever. Right? I've stuck to my guns. I don't change my views. People, even when it comes down to the recession, I mean, I am very much of the belief that this recession was already pre-bailed out, and that they are allowing the failure to exist to get rid of the irrational exuberance. I mean, it's something that we have covered many times. I don't have time to go over it right now. But again, it's pretty cool to see people going back a year and commenting, saying, man, nice call. You did it. You actually nailed this one. And I'm like, what do you mean actually nailed this? I've been nailing this for a while. All right. Uneducated Economist, you guys let me know.